Let's talk about a lifestyle price anchor that completely breaks the matrix of standard retail investor sentiment. Picture trading screens flashing across Wall Street, Helsinki, and the electronic exchanges of Europe, where Nokia, yes, Nokia, trades with a renewed, ferocious pulse that has shocked old-school market participants. While everyday retail forums, mainstream financial media headlines, and casual day traders on X and Reddit spent years writing off the company as a sluggish legacy telecom hardware dinosaur trapped in the graveyard of the early 2010s smartphone wars, institutional smart money has quietly engineered one of the most violent, fundamental structural re-ratings of the decade. With the stock rallying over 140% year-to-date and touching multi-year highs not seen since the golden era of physical mobile handsets, the consensus narrative is currently experiencing a collective jaw-dropping identity crisis. Retail traders staring at price tickers are asking the exact same superficial question: how is an old flip phone and cellular tower company suddenly printing multifold gains in the middle of an artificial intelligence cycle? The answer exposes a profound market mispricing, a blind spot born of institutional laziness and retail anchoring bias. Traditional financial media loves to categorize companies by their historical labels. They look at Nokia and see a legacy purveyor of base stations, cellular antennas, and dusty 4G and 5G infrastructure contracts that rise and fall with the sluggish capital expenditure cycles of telecom carriers. But while the market was busy staring backwards at legacy mobile networks, the physical reality of the internet underwent a seismic engineering shift. We have entered an era where large language models, cluster scaling, and hyperscale data center construction have slammed hard against a brutal, unyielding physical wall, the data transfer bottleneck. Most retail investors think artificial intelligence is purely a silicon story, a game won or lost solely by who has the fastest GPU or the most advanced 3-nanometer foundry node. They track every whisper surrounding advanced packaging, HBM3E memory chips, and thermal design power envelopes, completely missing the macro reality that an IR cluster is only as fast as its weakest link. And today, that weak link is no longer just inside the processor, it is the optical transit highway connecting thousands of distributed IR data centers across continents. Training a frontier model requires hyperdense, ultra-low latency data exchange that standard copper wiring and legacy networking pipelines simply cannot handle. Photons must replace electrons. Optical transport, coherent routing, and high-capacity data center interconnect fabrics have transformed from boring utility infrastructure into the absolute gatekeeper bottlenecks of the entire artificial intelligence revolution. This is where institutional capital recognized what retail completely missed. Nokia didn't just sit still. Through a calculated series of strategic portfolio overhauls, massive R&D reallocations, and critical acquisitions like its monumental integration of Infinera, the company quietly morphed into a global superpower in optical networking, IP routing, and high-performance photonic transport. When hyperscalers like Microsoft, Amazon, Google, and Meta construct the multi-billion-dollar data center complexes required to feed next-generation agentic AI, they aren't just buying chips, they are buying the foundational optical architecture that moves petabytes of data at the speed of light without melting down from thermal throttling. Nokia's application-optimized optical networking portfolio provides the exact coherent routing and ultra-compact transport sleds required to keep these massive IR clusters synchronized. Yet, because the stock trades under a historic ticker symbol that millions associate with bygone consumer nostalgia, retail investors continue to trade it like a meme or a slow-moving dividend trap, completely blind to the fact that its network infrastructure segment is now riding an unprecedented IR-driven supercycle. The market mispricing exists because quantitative valuation models and casual retail sentiment are anchored to a dead past, pricing a vital IR infrastructure monopoly as if it were still a commoditized telecom hardware vendor. To truly understand how institutional heavyweights are playing this structural breakout, you have to look past the intraday noise of retail sentiment and examine the raw plumbing of daily trading volumes, options positioning, and macro accumulation patterns. Over recent quarters, Nokia's earnings reports have consistently shattered Wall Street consensus, highlighted by explosive performance metrics such as a staggering 54% year-on-year comparable operating profit that sailed past analyst estimates and booked over $1 billion in fresh IR and cloud network orders in a single quarter. When a legacy industrial giant posts numbers like that, it triggers an immediate internal war inside institutional asset management firms. Passive index funds are forced to re-weight, systematic quantitative momentum funds trigger aggressive long algorithms, and fundamental long-only equity funds begin the arduous process of rewriting their valuation models to account for a radically expanded addressable market. However, this transition has not been a straight upward line. It has been a masterclass in institutional accumulation disguised as macro volatility. Whenever broad market jitters flare up, whether driven by sticky inflation prints, shifting central bank interest rate expectations, or sector-wide profit-taking in technology, retail traders panic. Terrified of giving back recent gains, retail accounts flood trading forums with worries about historical telecom stagnation, selling into weakness and getting systematically shaken out near local support zones. Behind the scenes, institutional desks step in precisely during these liquidity vacuums, absorbing blocks of shares and executing large-scale accumulation programs. They use the market's lingering skepticism toward legacy mobile networks as a cover to build massive multi-year strategic positions in Nokia's high-growth optical and IP routing divisions. The daily order flow reveals a fascinating tug-of-war. On one side, you have short-term momentum traders trying to scalp percentage points based on daily headline volatility. On the other, institutional block orders establish an immovable baseline of support. This dynamic is further supercharged by cutting-edge technological validation, such as Nokia's expanding IR-RAN alliances with industry titans like NVIDIA, designed to integrate cloud-native computing directly into radio access networks. Wall Street equity research desks have taken note, with aggressive bull case price targets stretching towards the $20 mark as analysts model out the full potential of the IR-RAN and optical supercycle. Pause right here for a second and look at your own portfolio management strategy. Where do you stand in this transition? Are you holding a core position in Nokia and letting the multi-year optical supercycle compound, or are you sitting on the sidelines waiting for a deeper macro pullback to load up your shares? Drop your thoughts, average costs, or accumulation targets in the comments below, because knowing whether you're playing the short-term noise or the structural wave changes everything about how you manage risk. To appreciate why Nokia's current incarnation is fundamentally detached from its past, we must dismantle the outdated historical framing that still clouds public perception. For the general public, the name Nokia evokes indestructible 1990s mobile phones, Snake, polyphonic ringtones, and the tragic corporate hubris that missed the initial Apple iOS and Android smartphone revolution. Even among more financially literate retail investors, the post-smartphone era is viewed through the lens of the Microsoft handset acquisition disaster and the subsequent pivot to becoming a pure-play telecom equipment manufacturer, competing fiercely against Ericsson and Huawei in the rollout of 4G and 5G cellular masts. That old business model was a brutal, low-margin treadmill, selling base stations to telecom carriers who were perpetually cash-strapped, suffering from declining average revenue per user, ARPU, and slow to upgrade their network architecture, meant Nokia's top line was tethered to a sluggish, highly cyclical capital expenditure diet. Gross margins were squeezed by aggressive competitive bidding, and future growth was capped by the physical limits of global population coverage. After all, there are only so many cellular towers you can build across a saturated planet. Enter the modern operational reality of the 2026 enterprise layout. Following comprehensive internal restructuring programs designed to streamline operations and eliminate bureaucratic bloat, Nokia operates as an elite application-optimized technology powerhouse anchored primarily by its crown jewel, the Network Infrastructure Division. This segment is subdivided into specialized technological moats that bear almost no resemblance to legacy cell towers. First, Optical Networks has emerged as the definitive growth engine of the entire corporation. Driven by the explosive integration of the Infinera acquisition and proprietary coherent optical engine, Nokia provides the ultra-high-capacity transport systems that link massive hyperscale data centers together. These systems utilize advanced coherent pluggables, open modular transport platforms, and intelligent line systems that maximize bandwidth while minimizing thermal output and power consumption. In an era where data centers are literally constrained by local electrical grid capacities, Nokia's ability to deliver energy-efficient optical transport is an unassailable competitive advantage.